Hey everyone, today on the final bar, it's growth over value in the markets again today as interest rates pull back from yesterday's peak. Callie Cox of eToro is going to be joining us from North Carolina. She'll share her own take on the value versus growth debate. Also, company reporting earnings, you may not have heard of it, all over everywhere. NVDA reporting after the close today. Will this mean the end of the AI craze or just the beginning? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit was really designed many moons ago, right? Centuries ago even, to empower investors to better understand market movements and market dynamics. About 100 or so plus years ago, you had sort of modern technical analysis, which was really designed to empower individual investors to have any chance at competing with the robber barons, right? The small number of people that dominated the financial industry at the time. I would say still in 2023, the things that Charles Dow and many others, Jesse Livermore and W.D. Gann and Elliott and others who really created the foundation of modern technical analysis, I think still very much hold true because the markets still are driven in so many ways by investor sentiment. I would argue more investor emotion and the extremes in emotion. The prices will tell you when investors are euphoric or desperate, when they're panicked, and when they're incredibly optimistic. And by looking at trends and looking at shifts in those trends over time, we can really recognize the change in sentiment and hopefully anticipate where the opportunities might be. We've got a lot going on this week, and we're sort of getting to some really news-heavy moments with NVIDIA reporting after the close today. A lot of build-up for this event. Growth stocks kind of rallying in anticipation of what we're going to learn here. The last three reports for NVIDIA have meant a pretty good gap higher and further upside to be had. Is this just the next step higher in this AI-fueled rally of 2023? We shall see, but let's get to the market recap and see what the charts did today, what kind of setup we have going into the aftermarket hours. Before we get started with the recap, let's answer a poll question. Make sure you subscribe to our YouTube channel, of course. Follow us on the socials, and you'll get our next poll question. We asked you recently, where will QQQ be 1 month from today? Let's keep it simple. At least 10% higher, at least 10% lower, or within 0 to 10% higher or 0 to 10% lower. Looks like 37% of you, the most votes, for between 0 and 10% lower. Another quarter of you said between 0 and 10% higher. So my math would say 62%, almost 2 out of 3 said within 10% of current levels. Let's look at a chart of the QQQ and just kind of see what that would actually mean. So this is the QQQ going back for the last 12 months or so. We're currently finishing today right around 370 for the Q. So if you go 10% down, that would take us sort of in the low 330s. That would take us back to the May low. Just a couple months ago. 10% higher above current levels would take us to a new high here for the cycle, a new 52-week high for the QQQ, and would get us up to, we'll call it maybe 410 or so if this scale would go higher. So it's interesting. I think the reality of this market, at least from my seat, it's hard to imagine an over 10% move in either direction, right? Just given the competing narratives that we have. And I would say right now, you have NVIDIA reporting earnings, potentially a bullish outcome if there's a nice win, and implications that there's further upside for semiconductors, driven by further upside valuations for semiconductor stocks and other things related to AI. Of course, they can gap to the downside as well. But what's interesting with how growth has done so well now, we have rates in the upper stratosphere and continue to go higher until this week, right? We're seeing a bit of a pullback, but we've seen higher rates, which tends to be a bit of a headwind for growth. So you have a market driven by the outperformance of growth, and now the conditions becoming less hospitable for growth stocks. So what's interesting for me is, given all of that backdrop, about a third of you said we'd get at least 10% of a move one way or the other. This is one of those times, by the way, that I tend to think of the markets from a simplistic standpoint in terms of your vehicles. I tend to think of, do I want to be long or short this particular asset? And I often even simplify it even more and say, do I want to be long or not, right? I can be long this stock, or I can be out and be somewhere else, and that's the question. What you have to remember is, depending on how you would answer that question, depending on what your thesis is, you can use the options market, you can use a lot of other tools to sort of express that point of view with a particular position. And that's something that came out of our live Q&A earlier today on YouTube. I had a question about leverage, actually inverse ETFs. So my comment was, analyze the underlying. If you're thinking about doing the short QQQ here, right, the SQQQ, I would analyze the Qs first, right? Analyze the underlying chart, come up with your assessment of where you think we're at and what you think may be next, and then think of inverse ETFs, leveraged ETFs, options, futures, whatever different things that you can pull. Think of those as different ways that you can express the thesis that you came up with on the underlying asset. It's so interesting to me, though, that 10% above or below, totally reasonable, right? In the next 1 month, getting outside of that seems extreme to me, but it has happened before. And I think recognizing what's that line in the sand, what's that level that if we broke it, you would have to revisit whatever thesis you're on, I think is an important thing to think about today, not waiting until it happens. Let's keep going with our market recap and look at how the markets played out today. This was yesterday's session, sort of drifting lower for the S&P. We can see we were higher out of the open today. We pretty much continued higher until right after lunch, kind of settled into this range around 4430 to 4400. But by the end of the day, the S&P finishing up over 1%, 1.1% higher to 4436. The NASDAQ composite outperformed today, up about 1.6% to 13,721. You can see mid caps and small caps all up about the same. So large, mid, smalls all having a nice up day, about 1.1%. The only red you see on our major equity sort of indexes at the front is the VIX, right? The volatility has continued to come down a little bit, about a full point lower from yesterday. Yesterday we were right around 17, VIX down to around 16. We'll look at a chart of the VIX if we have time here in the market recap. What I would remind you is, the VIX has fluctuated quite a bit here recently and was down to almost a 12 handle, if not barely just below 13, and then has now popped higher to 17, 18 or so. Now we're back down to around 17, but what you have to remember is all of that is still pretty low relative to where we've been over the last year and a half, 2 years or so, right? The VIX was much higher, and I tend to think of a VIX below 20 as a low volatility environment, generally speaking. A VIX above 20 tells me we're in a more volatile environment. So we've spiked in volatility, but not gotten to the point that you think, okay, this is a bombed out market with extreme fear, extreme uncertainty. I've not seen that sort of reading yet. That's what a big bearish move looks like. This still looks kind of like the pullback within a bigger uptrend, I would argue, given the volatility observations to start with. We'll look at some more charts through the course of the show today, see if we can draw any different conclusions than that. In terms of the bond markets, interest rates coming down even further today. The 10-year yield down to 4.2%. Long bond yield around we'll call it 428, and the 5-year yield around 436. The short end of the curve, of course, still pretty elevated, and the dollar down about 1/3%. So not a big down day of any means for the dollar. Some green on the charts of commodities, and again, one of the other themes that came out of our live Q&A on YouTube earlier today were questions about the commodity markets. We talked about FCX, Freeport-McMoRan, talked about gold. We had questions on uranium. Kind of went all over the material space. And interesting to see the GLD and the SLV, gold and silver, both up today. The GLD up about 1%, the silver ETF up almost 4%, and copper prices up about 1%. The energy part, things like oil and natural gas, actually down today. And energy had a pretty rough day relative to other sectors. It actually ended up being the only one out of the 11 S&P sectors in the red today. Finally, cryptocurrencies. Haven't said this in a while, but a big up day for Bitcoin, right? Haven't seen one of these in a little while. Bitcoin's sort of been retracing down to support or potential support around 25,000. We actually got right down to that range here over the last couple days. Seeing a nice pop to the upside. So during the U.S. equity trading session, as growth stocks and I guess more traditionally offensive parts of the market were actually rallying, risk assets were moving higher. Bitcoin, Ether prices moved up as well. Bitcoin currently up over 2%, Ether prices up over 3%. Bitcoin's still below 27,000, but sort of teasing that level through the course of the equity trading session today. Finally, looking at the sector movements, it was growth at the top with technology, the XLK up 1.8%. Communication services, the XLC up 1.6%, followed by REITs, which were number 3, up about 1.4%. As I mentioned, energy, the only sector in the red, and it was only down slightly, about 0.3%, followed by materials and healthcare, both slightly positive. Let's go to a chart of the S&P 500. We've talked about some of these key levels and key lines. Let's see what happened today. So, over the last couple days, I guess through this week, you've seen Monday, Tuesday, Wednesday's session sort of pushing higher, making a higher high and higher low every trading day from the previous session. We closed near the highs of the day. Certainly the tape having sort of an optimistic feel going into the close, a nice accumulation through the course of the day. What's interesting is, so for now, this pullback as we tested 4,600 and rolled over, breaking down through the 50-day moving average, I would argue a pretty important development over the last week and a half. Now we've pulled down to 4,300, but we've not broken that yet, and that's the pink shaded area on my chart. That actually comes from the August 2022 high, which is an important level that we watched. We actually broke above there, retested it in June, and now we're kind of pulling back to this level. So the bearish argument at this particular moment is we are now pulling, rallying back up to the 50-day moving average. This is where, if this is a classic breakdown phase and that there's more to go, pretty reasonable that you break down through something like the 50-day, you retest that breakdown level from below, and then you have the next leg down, that dreaded C wave, right? Think of this as an A wave down, that initial drop. The B wave is sort of that, short rally, and then you have another leg lower. We could certainly be setting up that way. I think the price gets back above the 50-day moving average. All of a sudden, this has a bit of a different feel, and I would still think of that as a general short-term barometer. We're above the 50-day, and the 50-day is going higher. Things aren't getting that bad. We trade below that moving average, and I think things could be much more concerning. So for now, we're sort of in that no man's land of the pullback. Definitely seems to be happening. But it's not that bad yet. And for me, 4,200 is that it's getting a lot worse level. That's that line in the sand for me, where if I'm not short or super defensive or thinking way more about capital preservation than I have yet, the break below 4,200 is where I would probably need to reconsider sort of overall positioning and all that. For now, though, certainly seems to be a constructive pullback. Pulling back for now, remaining above that 4,300 level. That might be the level to watch if you're setting an alert on the Stock Charts platform to sort of track the movements. New Dow theory, the reason why I wanted to show this chart, part of my morning coffee routine is going through a series of charts and just checking in on all of these major averages and breadth and sentiment indicators, ratios, just looking at comparative analysis. Worth noting, on a closing basis, the NASDAQ composite has literally pulled back to a trend line from the major lows year to date. If you look at the low from December of last year, from March and April of this year, it lines up pretty well with the low over the last week. So again, the NASDAQ composite actually holding trendline support as we're illustrating it here. The S&P's trendline, of course, a little bit further below. It's around 4,200. That's part of why we see that as a sort of a magnet price or a pivot point for the S&P. The NASDAQ's actually bouncing off of that level of support for now. So again, as long as we hold that sort of trend line, how bad are things getting? Not that bad. We start breaking a trend line like this. This is when I would immediately look left on the chart, start using Fibonacci retracements, and think about, all right, now that we've broken that and that's not holding, what's next? All right, where's the next level where I might anticipate buyers coming in? So we're bouncing for now off a pretty important trend line, I would say, for the NASDAQ composite. I mentioned Bitcoin, so I'll show you briefly the chart of Bitcoin and sort of how it's played out here. This is on my intermarket analysis chart list right here. So, what we talked about with Bitcoin, again, I like to think of things in phases, right? Which is at any point a market is going up, it's going down, or it's going sideways, or how I would loosely label an accumulation phase, a distribution phase, or a consolidation phase, right? What's sort of the overall kind of primary trend to think about in the market? Bitcoin, I think, has clearly been in a consolidation phase. It's been sideways, and we set the range of 31,000 on the upside and we'll call it 25,000 on the downside. It's really been the story here for the last 6 months, right? After testing that level 25,000 in February, we broke above it, and now that's become support here in June. 31,000 was the peak in April. We retested that in June and July with this bearish divergence that played out pretty well, and we came back down. We're now below the 200-day moving average, which does not make me feel particularly comfortable about the overall configuration of this chart, but we are holding support, and this level of support I think is an important one. This purple shaded area is the June low for sure. It's also the Fibonacci support level. If you take the November low and the April high, 38.2% of the way down is right around 25,000. That's where we hit support in June. That's where we hit support again in the last week or two. So that level holds, and I think this is at worst a consolidation phase with potential to sort of, again, remain in this range. There's certainly some swings that are tradable opportunities. It's not a raging bull chart, I think, until it gets above 31,000 and gets out of this basing pattern. But for now, we're kind of finding support at the lower end. I think a chance of retesting, getting back to the upper end of that would be pretty important. I think a break above the 200-day would be an important level to confirm that new upswing may be starting to happen. Have to talk about NVIDIA, of course, reporting right after the close today. Nice update today. Yesterday, you had a bit of a sell-off. It gapped higher and traded lower, and the stock got up to around what we'll call it 460 yesterday before rotating. Sorry, 480 before rotating back to the downside. Today, sort of gaining some of that back as we look at the after-hours trading. And as a reminder, on the stock charts platform, the best place to look at after-hours trading is using our simple summary page. So two ways you could get there. At the top, switch this to simple summary and just type the ticker. Or if you're looking at a chart like this one, just go below the chart at the very bottom. You'll see these clickable links, and you can go to the simple summary page. For an equity, it'll tell you when it's reporting earnings, certainly if it's today or tomorrow. So if it's an actionable moment, and we'll show the last trading session or the day session, and then after hours trading here. So for now, not much change. I think we're sort of waiting to get the official numbers and seeing what sort of move there is. But this is a page I will be watching certainly over the next couple hours. I would encourage you to do so. The setup for now, again, I mean, if you have to make a decision as to what is the configuration of NVIDIA at this moment before the after hours, before the report, pretty constructive, right? If you had to pick bullish or bearish, I think the bullish trend over time is pretty clear. And I think NVIDIA is a great example of a leading group, semiconductors, that overall has done very well. Broke down briefly and got down to around 400 first week or two in August, but from there has now recovered it, now once again testing high. So this is one of those binary events, good news from NVIDIA, and certainly in terms of an outlook and that thinking that there's still upside for names like this that are pretty much a direct play on the growth of AI and how it's and how widespread it will become. But as an actionable idea today, I think NVIDIA's earnings report probably gives that opportunity to the upside. On the other side, if you come out of that earnings call thinking, wow, this is a theme that is now probably played out, or at least we've gotten a little too far over the front of our skis, that's where a chart like this could go down very quickly. But in the short term, I think the previous highs at 480 are obviously the level on the upside. Look to see if there's a gap above there, and if so, do we hold that on any pullback? And then 400 would be the downside level. We break something like that going into tomorrow's session. I would be concerned about what that means for NVIDIA, but certainly for the broader growth space and our major benchmarks, of course, as well. Now, we have to mention charts like Apple. What's interesting about NVIDIA, kind of looks like Apple did before the gap lower, and I don't want to, that's not a fair assessment to say Apple did this, so obviously NVIDIA is going to do that a month later. But it does tell me there's some similarities between growth names that have been on uptrends. And the reality is when a stock like this keeps working, it keeps working until it doesn't. I think there's an inertia in the markets as a price continues to go higher. Again, this is what happened with the gap lower, and we can see how things faded after that. Just finally, I'll mention Nike, sort of a Pacific Northwest company, gapping lower today. A lot of movement in names. Let's see, Bath and Body Works, BBWI, others gapping as well. But what concerns me about a chart like Nike is the fact that it had an established support level around 103, 104. That is now broken. Now we're below $100 a share. And when we change from a 3-digit number to a 2-digit number to the left of a decimal point, I think that can often be a pretty important wake-up call for investors that are looking for some opportunity in a name like Nike. I would love to see the chart show you that there's accumulation. I'm not seeing it yet. That's our market recap for today. I want to bring on today's guest, Callie Cox. Before we do it, a couple quick announcements. First off, we welcome your feedback on our show, of course, on our wonderful guests, on your fantastic host as always, but especially we want to hear your questions. What are you running into as you are analyzing the markets and trading using the technical analysis toolkit? Our email is thefinalbar@stockcharts.com. On X, /Twitter, /whatever the name is now, @FinalBarSCTV. Just tag us in a comment there. And of course, on our YouTube channel, just drop a comment below the video you're watching for this show or any others. We'll gather those questions and hope to answer yours in our next mailbag segment. I want to welcome on today's guest, Callie Cox. Callie's a U.S. investment analyst at eToro, coming to us from Charlotte, North Carolina. Joined us on the show earlier this year. We had a really good conversation. Callie, good to have you back. How have you been, okay?
Yeah, thanks for having me, Dave. I've been good. Kind of enjoying this breather in markets, especially like nicely timed during the summer.
It's an interesting, we sort of have the summer doldrums. I feel like this feels like the calm before the storm in a lot of ways, right? Because we sort of have all these narratives that seem to be playing out. I'd love to get through some of the charts that you wanted to go through with us, starting with the big picture. Like, let's look at the S&P 500. We've had a bit of a drawdown off of a new swing high around 4,600. What have you seen, and what are you expecting going forward here?
Yeah, so I want to preface everything I say with I'm a macro analyst. I don't dig too much into individual stocks, but I do look at the overall market and how different sectors, work their way into those prices we see on the screens. So, of course, I'm going to throw up the most classic chart you can expect, the S&P 500 against its major moving averages. But Dave, I want to show you one thing that I noticed about a week ago. So the difference between that blue line on the chart and the red line on the chart, the 50-day and the 100-day moving averages, actually widen out to about 4% earlier on in August. And to that, that tells me, I look at that and I see a market that's had a lot of momentum in its favor over the past month or so, month to 2 months, especially when compared to the last 3 or 4 months. And we've all seen it with our own eyes, right? The stock market has rallied so hard this summer, and now we're seeing a bit of a pullback. I'm showing you this because, it looks like the stock market simply stretched too far, too fast. And, add that up with, a lot of encouraging economic data that we're seeing, a lot of encouraging trends in the underneath the market that we're seeing. And if you remember that sell-offs happen in healthy markets and sometimes prices just get stretched, I think you can make an argument for that being this case right now. And I think the moving averages are just another sign that that's happening.
It's amazing. I mean, I feel like if you're bullish here long term, I mean, one of the most helpful things we probably could see is a decent pullback, right? I get nervous if I'm bullish and things just go exponentially higher because all of a sudden it feels like you're chasing things. Arguably, this could be one of the better things to happen if you're on the bullish side, I would imagine. Let's talk about interest rates a little bit. Of course, we have Powell comments from Jackson Hole this Friday. A lot of focus on the Fed and what rising rates and higher rates have meant. When you're looking at the 10-year and how it's evolved, kind of getting above 4.25, now 4.3%. Where do you think we're at in this interest rate cycle, and how does that impact your thinking?
Yeah, so yields are the story right now, Dave. I mean, you look at the 10-year yield, it's sitting at nearly a 16-year high, around 4.3, or more about 4.2% after today's moves. But that's causing a lot of angst in stock markets and in crypto markets, and quite frankly, markets across the globe. And the reason why is because the 10-year yield is like a hurdle rate for our investments. I mean, it's the rate that you get on, a virtually riskless 10-year US government note. So, when you're taking on more risk than treasuries or US government debt, you should expect more return on the back end. So that's why people use it as a benchmark of sorts. And that's why when the rate on the 10-year yield gets so high, it kind of freaks people out because the bar is just that much higher. And, if you think back to, Finance 101, it's the time value of money as well. A higher rate cuts into future cash flows. So throw up the 10-year yield. We have it around 4.2% right now, which doesn't seem high, but it's the highest in about 16 years. And we've seen it rally quite a bit over the past month. And Dave, I know that you can get into the technicals a little bit more than me. I look at the technicals right here and I see some patterns already. I see that 50-day moving average bouncing off of it, stretching a lot higher than what we've seen over the past few months. And, it's really hard to justify a 10-year yield at these levels too. I mean, yes, the economy is doing really well. That's a great story to be investing on, but the Fed is putting a lot of pressure on the economy too. And if you believe the inflation picture has made a lot of progress, as we believe, then you'd probably expect a yield that's a little bit lower. But, that isn't the case. And that makes me think that yields may not stay as high as this for too long. They may stay high, don't get me wrong. I mean, we might not see the 2% 10-year yield that we got back in the 2010s anytime soon, but 4.3% does feel a little high to me, and I think the technicals show that too.
Some have said just here recently, of course, we're now looking at 4.2%, which seems astronomically high compared to zero. But if you look at the long-term history, these are still relatively low. You mean when you're looking at the interest rate environment over time, do you feel like that era of easy money, zero interest rates, is that now in the rearview mirror and we just need to adapt to this new reality of rates kind of in this area? Or how do you think as a secular shift, where do you think we're at in sort of that trend?
Yeah, well, it's funny you ask that because if you had asked me that back in 2019, in fact, I remember saying this, I would have said that rates had had a lot of pressure on them because
Mm,
of global buying, because of demographics, and there was a good argument for the 10-year to stay around 2%. But then a pandemic happened, a lot of changes in society happened that none of us expected, and now we've seen inflation tick back up to 9%. Come back down, and the 10-year yield is trying to find its footing. Bonds in general are trying to find their footing right now.
mm.
I think there is an argument for yields higher than the 2% average yields that we saw in the 2010s. I mean, the Fed, when you think about short-term interest rates, they see a neutral rate or the rate of policy where they're not really influencing growth either way. They see it around 3% or so. So, we might not see the 10-year at 2% anytime soon, but we could see the 10-year hover around that 3 to 4% range. That feels about right. And if that's the case, I mean, we could see, value stocks, possibly take a bigger role in portfolios as people have to, kind of search for more, more profitable, more undervalued stocks, just because that hurdle rate is so high.
I love you describing it as a hurdle rate. That's a phrase I've not seen a lot, and I love that way of thinking about it. You're absolutely right in terms of the looking for excess returns above that sort of hurdle. You mentioned value and how value has started to come under its own and maybe the potential there. Can we talk about the trend of growth versus value? We have NVIDIA's earnings after the close today. A lot of focus, of course, on the mega cap growth leadership names. Now it's sort of been into question here in July and August as some of those names have come down a bit. What do you see as the trend going forward in growth versus value?
Well, I'm glad that we pulled this chart up because I think the last time I was on here, we talked about hockey stick charts. And this isn't quite a hockey stick chart. I guess you could call it a semi-steep hill. I don't know. What's the analogy I'll use here? I don't know. But this is growth. This is the growth to value ratio. And I believe we're looking at the Russell 1000 growth ETF over the Russell 1000 value ETF. And it's so funny, right when the year started, growth started rallying hard against value. And you can see that with the growth to value ratio increasing over time. But we've seen it stop. We've seen it stutter back a little bit, especially around the past month. And we think, and many people think that's because of yields. I mean, the 10-year
Mhm.
yield, again, going up to 4.3%, that 16-year high, has forced people to start looking for value in these markets. And that's helped value stocks. And when I say value, I mean stocks that are undervalued. I don't like using value and I explain something that's called value, but stocks that look cheap relative to their earnings, look cheap
Mm.
relative to the overall market. My colleague Ben Laidler says this really good thing that I'm going to throw out. If you want to find alpha in this market or in any market, there are two ways to do that. You find the growth or you find the value. And growth has been the story for most of this year, especially because rates, everybody thought that they had topped out. They thought, people thought that Fed rate cuts were coming soon, or at the very least, rate hikes were mostly over. And while that might be the case, 10-year yields are giving us a second take on that. So,
Mm.
in that anxiety, in that anxiousness around yields, we've seen people look toward value sectors or at least rotate out of growth. I think that could continue, especially if we see yields stay high. But, if and I like that the economy is doing well, don't get me wrong, but if we see economic data start to falter, if we see the Fed's pressure, bleed into the job market, for example, we could, see that rate cut trade or that growth trade fire back up again.
Mm. No, really well said. And thanks for kind of talking through how that relationship has changed. It's striking looking at the ratio, how different 2022 to 2023 has been. It's obviously a very different environment. We only have about a minute left, but I'd love to know, one area of the market where you've not really seen strength yet, Callie, is in purely defensive plays, right? Like consumer staples, which overall have been underperforming pretty consistently, utilities, REITs, random days where they're coming up, but still underperforming. I'm curious, what would you need to see to think, all right, now we need to start getting very defensive Is it an improvement in defensive areas of the market, as I mentioned, or is it more the S&P rotates or the NASDAQ rotates to a particular level? What would kind of tell you, okay, this is now something different where we really need to start, sort of hiding out and waiting things out?
Yeah, well, I can tell you right now, this environment of high yields and really strong economic data is probably not the environment to look at defensives, right?
Mm.
Because defensives have two pieces of value to us. They provide a sanity hedge when markets start dropping, and yes, prices are falling, but this seems to be like one of those, like I said earlier, one of those like small steps back, and ultimately what could be a strong bull market up. At least that's what the economic data is showing us. So, if you look at defensives, if you think that they're a sanity hedge and then a source of yield when yields are low, they don't quite fit in this environment. That
Mm.
doesn't mean that they can't fit tomorrow or they can't fit in the days or weeks ahead. For me to get worried, for me to start thinking about defensives as a bigger part of my portfolio, I'd have to see job market data weaken. I'd have to see inflation stay high and that bleed into the more growth focused data. I'd have to see yields come lower so that people are back to searching for yield outside the bond market. But that just isn't the case. And that's not to say you should throw defensives out of your portfolio. I think it's smart to brace for a recession right now because we don't know what cracks are forming underneath the economy. But for now, I have to call it like I see it. And economic data just looks way too strong to, be too shy in this market.
I like that. Don't be too shy in this market. You mentioned your familiarity with technical analysis. I give you a good grade here. You did well analyzing the charts and recognizing the trends. And I would agree from a technical perspective, we're not really seeing those dramatic breakdowns yet where you'd need to start feeling more defensive. It's still sort of in that healthy pullback kind of realm. Callie, awesome to see you again. Thanks so much for coming back on the show. Be well, stay safe there in Charlotte, and we'll talk to you again soon.
Yeah, thanks for having me.
That's Callie Cox. Callie's a U.S. investment analyst at eToro, coming to us from Charlotte, North Carolina. I love that discussion about our hurdle rate, right? And that's one of the realities I feel like when interest rates go up, there's this delay, there's this lag when rates go up to the point that they have to where it really starts to have ripple effects. There's those initial reactions, like those initial sort of consequences, but I feel like the impact tends to be felt over time, right? The next time you go to buy a car or buy a house or take out a loan or take a vacation, like that's when you realize the monetary conditions are different than they were. And I think that's one of the realities as you think about going to defensive is you basically need to be getting more than you would from bonds and savings accounts and those sorts of things. And those rates are certainly seeming to be going higher. Great take there as always, and a pleasure to speak to Callie Cox of eToro. We need to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. What I call the new Dow theory is basically an adaptation of Charles Dow's original work looking at the Dow Industrials and the Dow Railroads. Now we're looking at the S&P representing the old economy, the NASDAQ representing the new economy. There's some overlap in here. It's not a perfect measure, but I think it's a really interesting way of just looking at different major significant parts of the economy and the conditions that they are expressing. When you look at these charts on a closing basis, there's a clear trend that I think is prevalent. If you look at the October low of last year, or in this case, the December low in the case of the NASDAQ, the low here, the swing low in March, that was after that February-March 6-week drawdown. Then we rallied and made new highs in both cases. That was a confirmed, sort of a bullish confirmed signal, right? A confirmed bull market when both of them are making new highs. Look at how they've both pulled back, but the NASDAQ Composite has actually pulled right back to a trend line using those 3 major lows that I mentioned, including the April low as well. So for now, I think that sort of tells the story of a market that's pulling back within an uptrend. A pullback, a deep bear market correction always looks like a pullback at the beginning. I think the difference is the conditions continue to deteriorate. Instead of buying on the dips kind of working, it doesn't work, and you get stopped out when you take an initial position on that first pullback. Trend lines like this don't hold. So for now, I'm inclined to still label this as a constructive trend. and a pullback within that uptrend, that breaks, and I think we have to start questioning that thesis. Chart number 2 is gold. Gold and silver actually having a nice bounce to the upside today. Good to see. It's been a while since we've had that sort of move. I'm a little excited as I'm seeing Bitcoin bounce higher too. I mean, it's just interesting to see a bit of a change of character there. What's interesting about the GLD, by the way, is if you take the November low from last year, take the May high, 38.2% of the way down is right around 175. That was the low here in June, right around 175, 176. We kind of tested that same level over the last week, broke below the 200-day moving average, but really didn't go much further, and now we're gapping back above there. When we set a support level and then continue to support it, I was told once is chance, twice is a coincidence, 3 times is a pattern. The more that you test a level of support, the more that you test a trend line, the more that it's validating that that is a good representation, a good indication of the phase that we're in. And I would say once that stops holding, right? Once support is established and then breaks, it makes that break even more important. So for now, I would argue gold is finding support at a pretty expected level, right? Sort of a fairly reasonable level, 175, 176. We rotate lower. There's a lot of room to get down to previous lows, to get down to the next Fibonacci support, maybe around 166. But for now, bouncing higher. Can gold get it back above that trend line, taking the highs in May and July? That would be my question for that chart. Finally, Nike, right? You have to focus on gaps. There are gaps every day in the equity markets, pretty much guaranteed. I would argue the gaps, happening, predicting those ahead of time can be super challenging, if not impossible. But what you can certainly do is see what happens on that gap day, right? Through the course of the day, do you see buyers coming in and buying on that sudden weakness or undervaluation, or do you see additional selling pressure push the price lower? What happens the next day and the day after that? Do you see additional buyers coming in thrilled to buy Nike sub $100 a share, which it's not been at since November of 2022? I think this is an important chart to see if we hold below 100 or not. I think this chart above 100, all of a sudden the risk reward incredibly compelling, but let's get above that first level of resistance first. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close and now live on our YouTube channel here at Stock Charts TV for the Final Bar. Special thank you to Callie Cox of eToro joining us from Charlotte, North Carolina. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.